we'll be able to fund whatever our. See, last year we had, I think, about a 10 crore cash flow, and a good part of it had gone for repayment of previous loans in the first 6 months. And now current year cash flows also, this will be there, plus maybe some borrowing will be made to finance this whatever capex we are planning.
Got it, sir. So one last question. Generally what we see in India, whenever any industry, or specifically industry which is smaller and niche like ours, see any good growth, we see a lot of new players coming in and competition heating up. How do you see that coming up in the coming years? How are we prepared for that?
Yeah, so I think this is a very valid and a very good question. So there is, as of today, as we speak, there is a kind of a gold rush in the cutting business. In the laser cutting in India, the capacity is growing manifold, in the sense that in the last 2 years, the capacity of cutting in India must have grown by maybe 500% or something like that. It is that many equipments are coming in, and so large number of people are getting into the cutting business. Some of them will get into the fabrication business as well. But fabrication business, the kind of business, this business has its own gestation. This is not it's not a question of setting up a factory and putting 4 equipments in place, because when you talk to at least all these big organized players, the entry barriers are very, very high. In fact, though we are in this business for 15-20 years, for us to get into newer companies also is very, very difficult, because many big companies have stopped giving vendor codes to new people. They don't want new vendors. They are in fact shrinking the number of vendors that they have. So to that extent, I would say that competition from newer players, I don't expect that much. But the opposite of that is in fact happening, and that is that consolidation is taking place, and the smaller players in this business are in post-COVID. There has been a very big transformation happening. So even in who are vendors of these kind of companies that we work with, there has been a lot of shuffle. The small players, when I say small, I would typically talk in terms of single location company doing business of about 25, 30, 35 crores. These are the companies, many of them are taking a big hit because they are not investing enough in new technologies and or investing in people. So competition, I don't feel competition will be the problem. Which, if at all arises, is that the growth in our customers. I mean, our customers, if they don't grow enough, it could be a problem, because all the existing people in the business, everybody looks to grow. So if your industry is not growing, it could be a problem. But all the new players who come in, they are typically only looking at the very low end part of the business, which we have already vacated that space. We are no longer in that space at all. Our company's main foundation used to be cutting. That's where we made all our money, and that was the base on which this company was built. But now that has become completely commoditized, and as I told you, huge expansion has taken place. So I don't see that as a serious threat.
No, that was very, very, very helpful, sir. Sir, one last question, if I may.
Please. Yeah, we need to go to the others also. Yes, please. Yeah.
Just last question, sir. If we take a very longer term call, say 4-5 years down the line, what is our general aspiration as a company? Where do we see ourselves in the next 3 to 5 years? And what do you think is the major risk to reach that aspiration, which we'll always keep in mind, based on our experience in the last 20 years?
No, we are still not aggressive as far as growth is concerned, and that's why I think another 1 year more, this current year also is going to be critical, because we have taken decisions to expand capacity to get into a newer line of business. So how this pans out will tell us what we could do in 5 years. So moving very cautiously, because though I am very, very optimistic about the business scenario, also even more in tubes than in flat steel, but the beginning I'm making is in a very cautious way. I mean, the same thing maybe a decade ago, I would have gone with all guns firing. But now I think the way we want to move forward is, not to be over, I would say, to keep little bit of enthusiasm in check and, take things as they come. And yes, if things look much better and we start getting, results of whatever we are doing, then yes, we can press the accelerator as going forward. But as of today, I cannot really tell you in more detail about 5 years from today what could be the scenario.
No, sir. Thank you so much. That was very helpful, and all the best.
Thanks, Ankit. Yeah. Thank you so much. Yeah.
Thank you.
Yeah. Can you go forward, please?
Yes, sir. The next question is from the line of Dhanil Desai from Turtle Capital. Please go ahead.
Yeah.
Hi. Good morning, Arshad sir.
Good morning.
So my first question is, if we look at the, our trajectory in terms of, gross margins, I think we have done very well even in tough times. And as we are coming out of tough times, I think the gross margins are even improving. And as you are saying that we are focusing more on non-commodity products, export market, which generally, we believe is a higher margin business. So sir, with that 45% kind of a gross margin, generally as the growth comes in, the operating leverage is pretty high. So, first question is, do we see gross margin remaining at around this level or improving? And as we grow at 15-20% or even more, do we see our EBITDA margin reaching to, low teens or around mid-teens kind of a number? Is that the direction that you are thinking about?
Yeah, so very good question. You've really hit the thing on the head. So yeah, gross margins we expect it to remain in these levels, and that is those are the types of businesses that we are looking at. Only if we are able to get businesses which have that kind of complexity or the quality demands from customer due to which these margins are there, then only those businesses we are taking up. And in future also that's the kind of business that we would like to take up. And the problem here is that to increase sales very aggressively with this kind of products is proving to be much more difficult than I had envisaged. Because some of the customers, though they are very large, their capital spends are very large. What we are supplying to them is still very, very small, and it's still not that easy to increase, I think, sales there unless their own growth also. I mean, for example, ABB you would have heard as a company, again a very, very big player, also our customer, but still we are very small in that space. So to do this business, I think growth will be fast growth may be slightly challenging unless more of this churn takes place and some of the smaller players continue to get under pressure. But otherwise, yes, our target is to maintain these margins. So if we can increase turnovers, then we'll see EBIT. This kind of business should theoretically give you double-digit EBIT margins actually. But because our turnover is too small for the size of the company, for the size of the facilities, number of plants, etc., is the reason we are at these numbers. If we could grow more, then yes, it will help at the EBIT level.
Okay, got it. Sir, second question is on the steel tubes, and I understand that you are still kind of, it's a gestation period and you are still looking at various options.
Right.
But at a broader level, wanted to understand, from whatever limited understanding that I have, steel tube is there are reasonably large players, and I also assume that there will be many product SKUs, many applications. So within that, there are already established players, what is it that we are looking which is so exciting, where we can make our, good margins and still scale up? So, in the given scheme of things and competitive landscape, and since we are new player, why do you feel that we will be able to kind of, get into this area and scale up well?
Yeah. So this is what has happened is in tubes. Since you are from the investor community, you would be seeing the kind of growth that is happening in the tube industry. When I talk of tube industry, it is the people who are making tubes. But post tube, the processed tube industry is not keeping pace with that. So we are still processing those tubes in a very crude manner, and India is exporting a large number of these tubes and pipes from India going into various industries, whether it's petrochemical or so many other industries. So the reason I am optimistic is that we are going into a space of tube processing, not actually making tubes. In the tube processing area, lot of processing is being done with very crude technology. In fact, I am seeing today that 15 years ago, where we were in flat steel in India with much more outdated ways of processing, and now it has changed completely. Something similar will happen even in the tube space. So the areas we will be looking at will be tube supplies to equipment builders, equipment makers. We are again not going to go in the competition or the demands where we are. India is already very strong is in automotive space, in two-wheelers and all these areas. Tube usage is very good, suppliers are very good. But we are looking at those industries, and we are looking at the furniture industries, the hospital equipment, hospital industries, tube requirements in stainless steel. So what we are looking at is that the existing market is being served not in a sophisticated manner, and we want to come with the latest technologies and equipment so that our quality delivery will be much better. That's the reason I'm so optimistic.
Okay. And the last question. So again, given the backdrop that you talked about both on domestic market side and export market side, in the domestic market, some of the end user segments have some push or tailwind or some kind of a demand push, be it infrastructure, construction, real estate, and on the export side, you are seeing customers wanting to source more from India.
Right.
So given all that and the base that we are sitting at, which is a very small base, 130, 140 crores, why do you see a challenge for us to grow at 20% plus? And if so, why? I mean, where are the bottlenecks?
Yes, I do see a challenge, or rather, I have discovered now that it's much more challenging than what I thought it was 2 years ago. 2 years ago, my feeling was that market is a big market is there, and once we get our finances and other things in place, growth should be there's a lot of opportunity for growth. But I'm not finding that. We are definitely struggling to add customers to our profile. So we can grow at that pace. If we want to grow at 20% or 20% plus, then the only way to do that is to add customers to what we have. And that part is proving to be very difficult because as I also in today's talk itself said that in the large customers, the kind of customers we are addressing, they are all trying to, they are limiting the number of players who enter into their space, and therefore it is proving to be very difficult to grow faster. And that's the reason why we have shifted our focus much more to exports than to the domestic market.
Okay. Got it, sir. That's it.
It may seem to be a little contradictory, but that's what we find. So, or otherwise, we have to think a little bit differently and compromise and say that okay, we can with these similar customers or similar types of customers, we go in for lesser value-added products and we grow top line faster, and we have a product mix of where gross margins are 45-50%, and we also have products where there are just gross margins of maybe 30%, and that kind of a mix, that is also a possibility if you want to grow faster. That is definitely possible. But if we want to continue with this kind of thing, then it is a little challenging to grow domestically that fast.
But with export coming in, from what you are saying, if it scales up, then it adds up to the domestic growth. So if that part, starts scaling up, then we can go to 20% kind of a growth. Is that the right assumption?
Absolutely. That's correct. Absolutely. Yeah. Thanks. Yeah.
Thank you. The next question is from the line of Ankit Gupta from Bamboo Capital. Please go ahead.
Yes, Ankit.
Yeah, sir. Yeah, thanks for the opportunity. Sir, on the margin side, we have seen that there has been an improvement in the margins primarily because, our expenses haven't grown much in the current year. So, around 8.5% is what we have done this year. So, given the growth that we are expecting in the second half of next financial year and, traction across the various industries that we are serving, how do you see margins panning out for us for FY25?
Yeah. So, as far as margins are concerned, two major things. One, we talked about gross margin, which is variable cost to sale. So that part. Now when we come to the fixed cost or the semi-fixed cost, the major concern will be human resource cost. And it is a little bit human resource intensive, the work we do, because it's all tailor-made. So in that area, I see that is one area of concern which I see, because one is the lack of skilled manpower availability in this country. So we are investing a lot on our own, setting up a separate training facility in Gujarat to train more people for us and for others in the industry. But to contain that cost, we have set up a separate task force just to look into automation, and we want to go for increased automation with robotics and other simple special purpose machines or assisting machines, etc. So idea is to keep manpower numbers at the same level and increase sales from here by 50% or 60% from where we are, and not add any people. So that's the target. And with this in mind, current year, this month itself, we are installing a new robot in place in our Bangalore plant. And similarly, we will be automating so many processes as we go forward. So idea is by doing some of these automations, especially in robotics, initially appears to be commercially not that attractive, because manually you are not spending so much on capex, and you can say that work is going on, why spend so much on these automations. But as I see, unless we do it now, you'll always be behind the curve. So yes, human resource cost is the major concern, and that we are very aggressively working on that to keep that in control.
Sure. Because we have seen some increase, we have seen a decent increase in our employee expenses, almost 15% in FY24 compared to FY23.
Right. So those costs are going to increase, two reasons. One is, of course, the minimum wages are going up, and that is going to be putting pressure throughout the entire, value, this thing. And then, even for the better quality, the more educated staff, engineers, etc., those availability in numbers is very high, but good quality people to retain, you'll have to pay them far better. So that's why the only way to attack this is through automation and other things. So even our back end on software design, manufacturing, engineering, all those areas also we've been fairly weak in the past because of underinvestment in software. So that area also we are attacking. So but that I'm quite confident we'll be able. There is a lot of low-hanging fruit there, and we should be able to keep that in check. It doesn't appear to be, though it's an area of concern, but I think we will address it. I'm not too worried about that.
And sir, given the kind of growth expectations we have for the second half of FY25, for the full year FY25, how do we see growth for us?
Sorry, I didn't get that. Can you repeat, please?
The kind of growth that we are expecting in the second half of the next financial year.
Yes.
So how do you see the overall growth of the company in FY25? We ended this year at 140 crores. So next year, what kind of growth can we expect?
I think I'll pass because I don't want to give a number and then not be able to sort of achieve that. But as we discussed earlier also, the growth will not be very aggressive in the sense of anywhere between around, you can say on an average maybe 15%. That would be a good growth as far as we are concerned.
Sure, because we are setting up our Bangalore plant as well. So
So that is also unfortunately coming up a little bit, in the later part, only in the third quarter of this year. So the benefit that and the benefit of that in current year may not be that much as it will be in the subsequent year. So that's why, as I said earlier, if these things happen and go as per plan, then the subsequent year or 2 years should be much better. The growth should be faster.
Okay.
Yeah.
And sir, how do you envisage growth with our, larger customers on the construction equipment side? You're saying second half should see better, but let's say over the next 2 to 3 years, this business has been in the range of around 70-80 crores. So do you think this business has a potential to reach cross 120-150 crore over the next 3 to 4 years?
It should, because these are all as far as domestic business is concerned, these equipments are all going into road building and mining and all other infrastructure projects, including dams and all other kinds of stuff. So if these infra spending continues at this pace or even slightly lower pace, the business should grow from here, because even today our infrastructure equipment industry is very, very small compared to China. We are maybe less than 1/5 the size of China in this space. So the customers but one thing has happened is that many of our customers have been very over-optimistic with their projections in the past, and they have not been able to meet that because of too much cyclicality in the business, volatility. So customers are quite optimistic. They are all building capacities. Volvo is expanding, Caterpillar is expanding, JCB is expanded, put up a new factory. So all of them are growing in the expectation of more business from India and their own export business. But we have to see, what will happen. It's in the past, last 10 years, things have not been, it's always been up and down. We have not had consistent growth for 4-5 years in a row. So that, in that sense, it is a little worrying, but I think growth, it will come. Now, how fast it will come is a question, one has to answer. And again, one more thing which, therefore, what happens is that you have to be ready for that kind of big growth business to come, because once the business comes, there is no time to set up facilities and, get this equipment, get that, do that. So, you have to build capacities and keep that ready in anticipation of growth, and that is something that even companies like Caterpillar, who have deep cycles in their own business, is what they are telling vendors to do. And that is also the reason why they say that you should have more and more automation, so that you have flexibility in ramping up and ramping down. You don't have to throw too many people out or again rehire them. So this whole plan of building capacity and keeping all that is to see that when the times, when things pick up, you are ready with your capability.
Sure. Okay. Thank you, sir.
Thanks, Ankit. Yeah.
Thank you. The next question is from the line of Pradeep Rawat from Last House Blue. Please go ahead.
Yeah.
Thank you for the opportunity. And so I have a couple of questions. So first question is regarding our revenue potential. So what is our revenue potential from our current facilities, and what would be the revenue potential from the upcoming facilities?
Yeah. See, this, it's a little difficult for me to answer this is because it all depends on what business you are going to do from that facility. So, as such, one large plant, okay, let me answer that question in a slightly different manner. Today, we have a plant in Pune, which is maybe 3 times larger than Bangalore. But business being done there is less than half of Bangalore. So that is the potential to do more business is there. So with this new facility in place and all the existing setup, actually with balancing equipment and people and all that, it can be scaled up very substantially from here, in the sense of 250-300 crores business the whole company can do with these kind of facilities.
Yeah, both current and upcoming facility, right?
Yeah. It can be even more than 300 actually, but 300 is something that is definitely, doable if the business comes in or we are able to get the business on board. And therefore, again and again, I revolve back to export is that I feel that those kind of larger volumes in a shorter period of time will be possible more outside India than in the domestic market.
Yeah, so we are expecting huge revenue ramp up from exports, like you said, 40 to 50% plus kind of contribution we can generate from exports. So can you specify any kind of ballpark timeline for that?
It's difficult for me to say. I would say about 3 years is what I feel.
Okay, and that would be like serviced from our Bangalore facility or all over the all facilities that we have?
Oh, primarily Pune and Bangalore. Pune also and Bangalore. Because these two facilities, because of the quality of people that we have, more than people and now in future infrastructure also.
Yeah. And my question regarding that capex only. So what kind of investment are we putting into that new facility?
New new facility, see, this total maybe 7-8 crores, maybe under 10 crores of capex in that facility. And balance, we are also upgrading some of our other equipments as we go. So our routine capex will also be there. And as I talked about automation, so this automation capex is also going to be an ongoing thing. So with all this,